All right, everybody, let's get started. We got a lot of stuff to go through today. We got a lot of slides, a lot of really fun information. So we're going to try and take our time, really try and explain everything as much as possible, but please ask as many questions as you need to. So let's just go over what we talked about last time, just so we kind of get back in the frame of reference for everything that we're going to be discussing today. So we kind of talked about how we start actually structuring portfolios, how we actually put the things together, how we put, each asset in its place, and how we decide how much of it there is. So that's kind of our visual representation of both our lateral and our vertical integration. And then we have our super basic allocation guideline for like a balanced portfolio. If you kind of just like mindlessly, choose the right assets and toss them in here, you should have a pretty decent blend of the different stages, the different layers, and have a portfolio that works out pretty well. And that's exactly what I did when I chose these funds and I put them into that exact framework. So I generated a portfolio doing exactly that. So since we did that, it's also important to remember that each portfolio will be different based on its purpose. So I really like specific objective portfolios. That's why I don't like to roll everything up into one account and then have every goal funded from there for the most part. If that's necessary and it's simple and the client likes that, fantastic. But I'm a really big fan of saying, I like to put all my growth stuff in my Roth over here and take my income, maybe tax advantaged income out of a trust, and have a balanced allocation for an IRA for RMDs. Like I like to make very specific objectives for each account type, because it makes it a lot easier to choose those investments, and it also makes it a lot easier to emotionally cope with different performance. So if you see an account that's supposed to be your income and that's not very volatile, that feels really good. And then even if you have the same split, if you had it only one account and your growth assets drop by a lot, it feels like the place where your growth and your income, like it's performing really bad. But if you split it apart and say, my income is nice and stable, but my growth is down like 15, 20%, it's much easier to emotionally make that separation so that you feel a lot better about the income continuing and not so concerned about the growth doing what it normally does. So make sure that you bias your holdings towards those low-cost investments. Really make sure that fees are as crunched down as they can be. If you want to only use the cheapest index funds, all about that. Really, your portfolio can be as simple or as complex as you'd like, but just make sure you retain diversification and you understand what you're trying to do with each of the assets in there. So with all that said, let's start getting into the really fun stuff. We're going to start talking about modern portfolio theory. So this is really what helps us pick and choose individual securities. Like we know kind of the basic types. We know what treasury bonds are. We know what treasury bills are. We know what stocks are. We've talked about growth and value, but these might, when you finally say, okay, now which value fund am I going to pick, or which bond fund am I going to pick, these sorts of different measurements are going to help you evaluate that. So what we're going to use is Morningstar as sort of our frame of reference. It's an analysis software that you can access online, and there are a couple different ways to do it. So they have a bunch of free information, which most of that will be available. So if you don't have an account, you can just go on Morningstar, plug in a fund symbol, and see a lot of what we're talking about. But some of their more in-depth analysis is behind a paywall. So you can just get the retail version out there, or there are a couple different library cards that you can actually pay for and then get it for free, and it often charges you a lot less. So instead of being, 20, 30, 40 bucks a month, it might be that per year if you're using the library card. So we've got a couple things that we'll send out in an email about how you can access that. I don't remember what the specifics are. You want to chime in?
I want to chime in. So I sent the email late, but it is in your email right now. One of them is, I want to say, Fairfax Library. So you would apply online or print it out and mail it in, and then they'll send you, I think, a code to get in. And then in another library, I forgot what it is, but it's a similar type of thing. Yeah.
Yeah, so those will be available. But again, a lot of it you can find for free. Or if you want me to look up anything for you, I'm always happy to. So Morningstar provides a comprehensive, in-depth look at the investment products so that we can choose those assets for our portfolios. And there's a lot of things that we can use to evaluate both individual assets and the portfolio as a whole, because all of these things apply to groups of securities and individual ones as well. So what is modern portfolio theory in the first place? What am I even talking about? Modern portfolio theory is a strategy that focuses on investing in different asset classes to reduce investment risk while achieving the best return possible or a target level of return. So the idea is we say we have sort of an idea of how much return we want to get. You could say it's 7 or 8 or 10% or whatever. But the idea is you want to try to achieve it with the least amount of risk possible. You might be able to achieve a similar return of 5, 6, 7, 10% with one asset that has a lot of risk and is super volatile, but you might be able to achieve a similar return with something that's less volatile. For the most part, the relationship between return and risk is pretty direct, but there are times where you can have assets that just simply don't do super well for the risk that they're taking on, or the fees are really high, so that reduces their performance as well. So our whole point is that we want to try and get your target level of return with the least amount of risk that we can. So that's where a lot of these bits of information come into play. Each asset class has forecasted annual returns and levels of risk. So this is basically looking back at all the historical data, coming up with some averages and saying, based on all that information, what would be the statistically probable return and risk that's going to happen going forward. Then all of this gets built around that. Yeah, it's pretty much an average. Yeah. So investors can invest in multiple asset classes to leverage the maximum level of risk they're willing to take for a chance at more returns. Modern portfolio theory works by optimizing the level of risk an investor is willing to take to achieve returns. So that's just the definition of modern portfolio theory from Morningstar themselves. The guy who created this was Harry Markowitz, an economist, and in 1990, he received a Nobel Prize in economic sciences for developing modern portfolio theory. So his work popularized concepts of diversification and overall portfolio risk and return, shifting the focus away from individual stocks and bonds and things like that. So this concept has gotten tweaked a lot over time. It's been improved by a lot of academic studies and all sorts of different stuff. So we have a little bit more complex of a version of that today, but that's kind of where it came from. This is kind of a visual representation of what we're talking about. I won't go into depth explaining all of this right now, but you'll see this risk-free percent number down here. One of the assumptions that we make is that there is an amount of risk-free return you can get in the market, and that's usually represented by a 3-month treasury bill or something of the like. So there's a certain amount of percent I can earn. If I just go buy that treasury bill, I might be getting 4.8 or 4.9 right now, and that's our risk-free level of return. So we shouldn't have to take on any risk to earn that because we can just get it in interest from the government at any point in time. So the idea is that as we have higher levels of expected risk, we should also have higher levels of expected return. And there is this most perfect, efficient, direct relationship, but obviously you're not always going to get this super ideal portfolio. So there's all these different portfolios and individual assets out there. And you want to end up on a combination that gets as close to this direct relationship as possible, because then you're not taking on extra risk or losing out on returns just simply for being in different things. So the idea is create a combination that reduces your short-term risk and your overall risk as much as possible while still maintaining that best direct relationship between risk and return. That is a whole complicated thing, lots of statistics in there, but so it will take into account time because usually this will be on some sort of look-back period. Right, so in this graph, it's not taking into time, possibly, but this is just kind of more of a general, conceptually on high view. But so modern portfolio theory is not perfect because it makes two key assumptions. One is that the market reacts immediately to new information and it's priced in instantaneously. For the most part, that's relatively true because of how fast information goes. But, the other thing is that investors are all risk averse and completely irrational. And I think you and I both know that that is not the case. If you just think about it, if they were completely rational, nobody would sell in a crash. They would just keep holding if it fits their objectives. If they were completely rational, they would just follow the numbers and look away and they'd never feel weird about it at any day. No day would ever stress them. Historical risk statistics also break down on smaller time frames, and they can't predict future returns. So we can't predict something that happens in the economy like what's happening right now. We can probably say that it's reasonable that this will happen and that this will pass, most likely, but we can't predict exactly what's going to happen. We can't predict when it's going to end. We can't predict how long, all these things. And these super historical risk statistics, they just break down. So, for example, if you remember, we had a little small conversation about sequence of return risks, where your returns are not going to be the same year over year. It's not going to be 7%, 7%, 7%. It's going to be something like 14, -5, 20, and just like all these different ways. But if you average all of that together, you're probably going to get this similar measurement to that historical average. But then if you break it down to like a year, it's unlikely that all of these averages are going to represent the 1 year. 3 years might look closer, 5 years probably would look closer, and the more and more time you add, you're going to get closer to that average. That's what that conversation about the law of large numbers was before.
Morningstar is not allowed to project anything or any report, right? So they can only go backwards and back test. The SEC won't allow them. Insurance companies used to do that. Buy this policy, and if the market, if you get this, you'll get that. And then all of a sudden, interest rates fell, and you didn't get that. You had to add more money in a policy and cancel it and all that terrible stuff. So we can't even hint to what the future will be. We can say what we think it might be. And everything you see on the disclosures, he has to run through our legal department before even putting up a slide.
Yeah. So our goal with modern portfolio theory is to optimize the security selection within the allocations that we already determined with our lateral and vertical integration. So we use our lateral and vertical integration to decide the types of assets that are going to go in their place. Then we'll use modern portfolio theory to really narrow it down to I want this one, and this one with these sorts of statistics. So let's get started with a couple statistics that you would see on something like a Morningstar report. The first one is called beta. Beta is a measure of volatility or systematic risk. Remember, that's just the market risk. That's things moving up and down on a regular basis. When the market moves up and down, that's market risk of a security or portfolio compared to the market as a whole. Usually the S&P 500 will be that benchmark. So if you see something that has a beta of 1.0, that means it's as risky relatively as the S&P 500 index. Now a security with beta over 1.0 has more risk than the market, so it's likely that if you have a beta of 1.5 and the S&P goes up by 10% or down by 10%, the security that has a 1.5 beta will likely go up or down by 15 in comparison. So it's really just, you multiply that by the risk of the S&P or the returns, and that's probably what you're going to be feeling. And obviously the security with a beta under 1.0 has less risk than the market. So like looking at building balanced portfolios, for the most part, you would probably expect a balanced portfolio to have somewhere between 0.5 to 0.6 beta, because we have a decent amount less risk than the all equity S&P 500 index, because we want to squish that volatility a little bit. We want to have those bond positions. We want to have those cash positions that we can pull from to use for other purposes. And we don't want all of our money to be completely at risk at every moment. So beta is calculated in a little bit of a complex way. We won't go through the math and do tons of algebra right now, but I just want to throw this up there just so that you can see it in case it's interesting for you. So it just has to do with the variance of returns, where you have, the returns on the individual stock, the return on the overall market, how changes in the stock's returns are related to changes in the market's returns. So that's covariance, which is kind of the relationship of the variance, and then the variance is how far the market's data points spread out from their average value. So all those things together, it's really just about the relationship and how different are the variances between up and down movements, and how similar is that to something like an S&P 500 index. But really just remember what it means and its relative risk towards the S&P or whatever benchmark is selected. So in practice, what does this actually look like? What we're going to do is we're going to use a couple slides to compare ETFs or funds against the S&P 500 index. So we'll have a couple ETFs from Vanguard, and we'll display how beta can be seen in real data, what that actually looks like in terms of performance. So the S&P 500 will be represented by a purple line on the chart, while the comparing ETF will be orange. And together we'll look at these charts and we'll try and see if we can determine if they have the same higher or lower beta than the S&P 500. So to start with, we've got this one here. So remember, we've got that purple S&P 500 line, and then we've got this orange ETF line. So if you had to take a guess, how close do you think the beta is on these investments? And remember, yeah, so this is return. So this is just the price change of each asset. So the S&P has been up 347% over this like 20 or 20 something year. So it's really, really tight. And that's because the total stock market ETF tends to perform almost identically to the S&P 500. There's a little bit of variance in there, but for the most part, because total stock market indexes and the S&P 500 are so similar in composition at the top because of how big those companies are, you don't see a lot of difference in the returns long term. Sometimes having all those small cap stocks and more value and all that sort of stuff, that can help out in short term, but it's pretty close. So that would just have to do with what's in it. And there might be a little bit of difference in terms of the return calculated on the index versus.
Could it be that it has a certain amount of small cap?
Yeah, small caps would definitely help because they tend to outperform long term. Yes.
And just by chance, this has a level of small, that if small caps did well along with large caps, this one went a little bit higher.
Yep.
But we don't see that very often.
Right. So next we've got another one. So we've got two funds here. Remember, we got that S&P 500 in purple, and we've got that Vanguard ETF in orange. So if you had to guess, what do you think the relationship of the orange's beta versus the purple is? Well, you guys are right. It's a beta of 1.138, a little bit higher. Yeah. Yeah, so you can also remember, like, this is almost 14% more volatile than the S&P 500. That's a pretty strong amount of variance. Yeah. So that's Vanguard's growth index ETF. So that means that we're basically taking out a lot of dividend paying stocks, value stocks, and we've got ones that move around a whole lot. Yes.
Previous slide, please. I don't see it going under the S&P 500 at all. It seems like with that kind of risk, it would go under sometimes.
Yes, however, what I want to show you is particularly this right here. So yes, while the return of this did not drop under, you have to understand that this is assuming that you participated from here. So you would have to be in at like 2005 in order for this not to bring you under. But if you bought in here, this decline is much sharper than this one. Oh, okay. Like, look at the difference between that decline versus this one. It's about twice. So if you participated here, you'd feel a lot stronger of a loss. You would recover much stronger. But then you can also see, you know, the last couple of weeks, there's that decline that has just absolutely demolished that fund for the most part. And yes, the long-term numbers look really good. And that's why I preach zoom out every chance you get. But it really depends. Your reference point could be anywhere on this chart. Your reference point could have been right here when you thought, oh my God, growth stocks are the best thing in the world. And then they crash by a huge margin. So it's all about your reference point. Yeah, to do more with, because it's not just a relationship of it going up, it's both directions. So we're taking both the upswings and the downswings into effect because things mostly go up. The trend is that this is just going to keep widening the longer time there is. But what we're really concerned about is how far this goes up in relationship to this leg versus how far this goes down in relationship here. It's more about how each little section compares to each other on an average. Because sure, that's more than 1.14 or whatever that was, but it's really about the variance of both directions, not just the one single positive skew. So Obviously, that was that Vanguard Growth Index ETF. So now we've got one more. So again, our S&P 500 index in purple and our ETF in orange. So do we think that's more, less, or the same? You think it was in between the last two? Yeah. So here we've got a beta of 0.8669, or roughly 0.87. Sure. Yeah, so we've got that S&P in purple and then the comparable ETF in orange. Yeah, that's okay.
Yeah.
So the beta of that one is a little bit lower, and that has to do because we're looking at a value index ETF, like he was just saying. Those dividend stocks, those more value focused, not looking for tons of market share growth, those are going to tend to be less volatile overall. So beta can give us a general idea of just how risky any security or collection of securities can be. So it can be used for evaluating both individual funds as well as the overall portfolio. But one thing that I want to make sure you understand is that beta is relative, and it requires understanding the benchmark you're comparing to for accurate risk assessment. So for most cases, it's going to be the S&P 500 index. But if you compared a value fund to treasury bills, the beta is going to be wildly higher because that's a different comparison. For the most part, it's going to be the S&P 500. So trust that that'll be what it is most of the time. But it is a relative risk measurement. I believe so, yes. Yeah.
You can change it, but we compare our portfolios to the New York Stock Exchange because it's more of a broad 2,400 stocks, and it's not all just large companies in the third 10. So when you go to Morningstar, you don't reset it, it will save you.
So it's a little different because that's the advisor workstation version that you're talking about versus they're using the retail version. So the retail will compare it to the S&P. We change that because we generate the reports. So we like to compare against the New York Stock Exchange because it's a different collection. The next thing that we're going to look at is called alpha. So there's a little bit of a relationship between alpha and beta, pretty direct. So alpha refers to excess returns on an investment above the benchmark return when adjusted for risk. So it uses beta as a gauge of risk. So if we start from there, we say, okay, this stock has the same beta as the S&P 500, therefore it should return the same amount as the S&P 500 in any given period. And if it returns more than the S&P 500, the difference between what the S&P did and what the individual stock did, that's going to be our alpha. That's our extra return that was given based on the level of risk we were taking. So the returns above and beyond the expected amount for our given risk are what are expressed as alpha. Usually it's viewed as the value a portfolio manager adds to or subtracts from a fund's return. So if you see something like a managed growth fund and it's got a bunch of alpha, that means they're taking on similar risk to the S&P 500, but they're actually getting better returns over time. And then you can also see negative alpha, where you're taking on a comparable level of risk, but you're not earning as much return, which is, not exactly what you want. If you're got negative alpha, you want some sort of value because you're basically paying some of your returns to this strategy and this manager. And you want to get some value for that. Usually that's why you would pay that money to an investment advisor, financial advisor, versus the fund manager, because I want the fund to just get the same level of return, not pay a whole bunch of fees, but instead pay for planning with somebody like an advisor. So yes, yeah. So for the most part, I don't like to look at alpha on a 1 year because that can look kind of ridiculous, and I'll get to an example of that in a second. So I usually like to look at that at 5, 10 years plus. But again, for the most part, if you're following the investment strategies that we're sort of talking about, alpha is not really going to be much of the conversation because you're not looking for extra returns on the risk. I just want to take the right level of risk and then get those returns. So alpha is not super important for the way that we construct portfolios, but it is a good thing to be able to see. And if you've got a strong negative alpha, probably don't choose that fund. So the calculation for alpha is a little bit more simple than beta, but it's not exactly the easiest thing in the world. You basically plug in what the risk-free rate is. Remember, that was the treasury bill's interest. So that's the theoretical rate of return of an investment with zero risk, usually represented by the interest rate of a 3-month US Treasury bill. So it accounts for the risk-free rate, the amount of risk that you're taking, which is the beta. And so you'll calculate something that's called the risk premium, the market premium. So you take the return of the market minus the risk-free rate, because that little bit is the amount of return that you want to get. The difference between what the market is returning versus the risk-free, that's kind of what you're comparing to with. And then you multiply that by beta, and then you basically take that out of your return. And if you are comparably getting more than the S&P 500 for the same level of risk, then you've got alpha. If you're comparably getting the same, it'll be about 0. If you're comparably getting less, then you'll get less. And so this is all kind of relative, because if you have a security that has half the risk of the S&P, you expect to get half the return. So if you get 3/4 of the return, well, there's a little bit of alpha. If you get 1/4 of the return, there's some negative alpha. That's pretty much what that's talking about. So alpha accounts for the risk taken, as well as the return that could be made by taking zero risk, giving a truer measure of excess returns than simply just comparing S&P did 12, I did 7, and my beta is 0.5. You know, it's a little bit more accurate than that. So in practice, the riskier an asset is, the greater returns it needs to produce any alpha. Index funds don't have alpha because they track and perform the same as the index. That's their whole job. So they just perform the same. Short time frames can skew alpha a lot, which is why I said I don't like looking at it as a 1 year, especially during unusual economic cycles or due to the performance of a single stock inside a fund. Does anybody remember who Kathy Woods is? She had this fund called ARK Invest, or this company called ARK Invest, and they had a bunch of different funds. And she got really popular because she made a ton of money in like a year or two. And that was primarily due to Tesla stock just flying and doing like 1,000% returns. And everybody liked her. They were dumping money into her ARK technology fund. And then as Tesla came back down, so did the share price of her fund, because it was heavily overweight in Tesla. So that means that when that Tesla stock went up by a lot, she looked amazing. On the short term, her alpha was awesome because the S&P didn't do anywhere near what her fund did in that time frame. But then when it starts to fall away, the S&P continues to perform like it does, and she doesn't mimic those returns. So you can see, if we look at this chart here, I've got her ARK Innovation ETF up on the top and the Tesla stock down here at the bottom. And you can see a pretty strong relationship right here from the Tesla stock continuing to go upwards and driving her price up. And then as it comes back down, so too did her fund. Then she divests from her concentrated position. And as Tesla continues to go, she doesn't participate as much because she reduced it. So if I were just looking here, her performance looks awesome. It's like 500% or something ridiculous. But then it's kind of flat since then. So on the longer term, her alpha is probably not that great. And if anything, it's probably negative. You have a question?
My question was about something you said about fiduciary. That means that they have to do something in the client's self-interest, right? But don't they all have a fiduciary obligation?
To follow the objectives of the.
Yeah, their obligations are simply to what objective is stated when the fund is created or at any point in time. So they don't really have much of an obligation to you as an individual, except for they have to invest prudently along with their strategy. But if their strategy is take whatever risks they want, then they're just going to do that. So because at the end of the day, you kind of have to be your own fiduciary at that point because you're choosing the investment type. But yeah, they don't have a direct fiduciary responsibility to you, the client, so much as it is to their strategy.
That's why we're not put you in Bitcoin ETFs, because it's not quite there yet, regulated, or we're not allowed to put you in 3X and 4X high gambling things. You could buy it if that's the objective, they can do it all day long. But as a financial advisor, we're down the run and we got to do what's right for your retirement. Unless you're a gambler, then you have to sign it.
Yeah.
You said you're not allowed, you mean by this company, OS AIC.
Yeah,
Correct.
Mosaic or Fidelity or whoever the advisor works under to do all of our compliance and things like that. But that's good because we might not know about some rule that the SEC just came up with, so they train us very quickly. But if you want to make a lot of money, you have to, in a short period of time, you have to gamble, and we're not allowed to do that.
Yep.
Yeah.
So the next statistic that we can look at is something called R squared. So this one's a little confusing to understand, but it's the percentage of a fund's or securities price movements that can be explained by movements in a benchmark index. So you can kind of think, if I've got, say, a managed growth fund or some kind of managed fund that I've got over here, and then I've got the S&P 500, it's basically saying, how much of the returns that I see over here are just explained by what's happening in the index? And if you're paying a really high fee for a fund, you probably don't want all of your returns, especially if they're a comparable amount, to just be explained by the index, because why wouldn't you just buy the index for the same thing? So an R squared of 100% means that all movements of a security are entirely explained by movements in a benchmark index. So we can use this to gauge how similar our investment is to that index, and this can be particularly useful if there is, in determining if there's value in high fee funds, like I just mentioned, that invest in a common sector of the market. So the idea is that you just kind of take the unexplained variation divided by the total variation, and you subtract that from 1, and that gives you your R squared. So in practice, we'll do the same thing that we did earlier with beta, but we're going to do it with R squared, where we show a couple slides comparing the S&P 500 and an ETF from Vanguard. So we're going to do the same thing, but we're going to try and determine whether the investment has a strong or a weak R squared. So remember, it's similarity of returns, not necessarily their relative variance in terms of does it go up more or down more. It's do the returns follow a similar path? That's the more important part here. So if we look at, again, Vanguard's total market and the S&P 500, do we think this has a strong or a weak R squared? Strong, right. So we have an R squared of 99.34 because pretty much all the returns in a total stock market ETF are driven by S&P 500 companies for the most part. And then that little 0.66 will be your small cap companies, your mid cap companies that just perform a little different. But because in the total market, there's such a teeny, teeny, tiny little part of the picture, they don't influence this fund very much. So we've got another one here. We've got our S&P 500 index in purple, and we've got a Vanguard Energy Index Fund in orange. So do we think the R squared on this is strong or kind of weak? It definitely looks a bit weaker, doesn't it? And that's because it's got an R squared of 37.47. Energy stocks on the long term tend to perform very differently than the S&P 500. And it's kind of interesting to understand because that can be really affected by economic factors and global factors across the world. So even when US securities can be a little bit in their own bubble and just keep ripping for a long time, energy stocks are so tied to supply and demand that that can really affect the share price very strongly. So if you're looking at an energy index ETF, it's likely that comparing that against the S&P 500 is not really a fair comparison because of how simply different they behave on a year-over-year basis. Right, so this one is going to be pretty non-correlated, but you can see, like for example, if we just maybe like right here, if we were to look at this period in 2022 where the S&P crashed pretty hard, but the energy index held pretty even because it's simply a more like carved out piece of the economy. This piece of the economy stayed more stable for the most part. But then you can see that the S&P took off afterwards. So it's just simply different and in different economic periods. Yeah. Yeah, and that was really rough. It dropped by a lot,
COVID shut everything down, so people didn't use it, flushed out all the ships sitting out in the ocean.
Mhm.
And then what did we do in 2020? With oil?
What did we do? Oh, yeah.
But only because of the dividend. What was full price, the dividend was 3 or 4, but when it dropped 50%, now it's 6 or 7. So I personally loaded up on a lot of the oil funds because you couldn't give it away, right? It's out of the ocean. But that's a scary thought because it could go further and further. But then as they started coming back to work, prices came back. So that big dip there was kind of an anomaly. I don't know that it won't happen again because maybe everybody produces oil now and prices come down. But then does that mean the oil shares will go down? I don't know.
We've got another one. We've got our S&P 500 in purple, remember? And then we've got our Vanguard Growth Fund in orange. So do we think this is a strong or a weak R squared?
It goes down and up.
You'd be right, because you can see the pattern of the returns is incredibly similar. And if you remember why we talked about how the beta was different, it's because the more volatile stocks are the ones that are in the growth. So even though the returns are so different, the directionality and the pattern of them are so incredibly similar, they just have a higher beta. So that's kind of like how you can see that these different statistics can explain slightly different things. So we've got an R squared of 88.64 on this.
Now, if you have a portfolio with a lower R squared,
Mhm.
does that give you the comfort that you're slightly non-correlated to the index?
Possibly yes, but you'll also experience different returns. So you might not get the same sort of return.
If I'm worried about, although the growth is riskier
Right.
individually, the portfolio might have enough non-correlated assets that I'm looking for lower R squared if I'm worried about my nest egg.
If you want a lower R squared, you simply want to do different than the market. That could be better or worse. It's really not a determinant of whether you're going to be safe or not.
Okay, but you are non-correlated or negative correlated.
Sure. Yeah.
Right.
Yes. You can, absolutely, but it's going to usually be a bit lower, and because individual stocks are so unique, a lot of these comparisons will be kind of not super useful for individual stocks just because they're not diversified, and you'll just end up having returns that are just so wildly different anyway. And it can be entirely dependent on if they launch a new product or they do something different. Yeah.
So when the market goes up, when they say stocks float, so the market goes up.
Yeah.
Goes up. Is that information?
Yeah, that is definitely part of the relationship of R squared, because for the most part, as equities rise, all of the equities will tend to go up with them just because that is what's happening. So that will have a stronger R squared than something that doesn't float along with the stock market returns, for
With a
sure.
single stock, if you want to go for something that might have a strong future, you want a low R square, but a high beta.
Possibly.
So
Well, it
it's
just
a
depends
lot
on what you're looking
riskier
for.
than the S&P, but it's not similar. That would be a good search to just say, give me something that's not like the S&P, but has a lot more risk, but it's not popular yet. Because as soon as we start buying what's up or what's popular, it's too late. You got to go out and search the garbage heap and see what you can find.
So again, R squared tells you how much of the variance of a security's returns can be explained by the index you're comparing. And R squared above 70 is considered to be strong. So that's considered to be very similar. And we would expect an index fund to have a very high R squared, probably 98 plus. The higher R squared, the more useful beta is as a measurement of risk. So the lower the R squared is, actually the less useful beta becomes, because it's not relatively similar. So now beta is not a useful measurement of risk because beta is relative to the thing you're comparing it to. So if you're different than the thing you're comparing it to and you've got a really high beta, sure, it's a measurement of risk, but it could also just not be super useful because the similarity between those two products is not very close. So if you're using a relative measurement, that starts to break down if the returns are not similar. So with a weak or low R squared, standard deviation becomes more useful. So we'll talk about that one in a second. So remember that the index you compare to determines the validity of these relative risk measurements. If we compared VNQ, which is Vanguard's real estate ETF, to a real estate index, the R squared would be super strong. Same thing if we compared the Vanguard Energy Fund to an energy index. That R squared would be really strong because they're similar. So these statistics need context, and not all investments fit into well understood categories. And that's why we also need to have isolated measurements, which is what we'll get into now. So we've got three measurements up on here. one is mean return, which is the expected value or mean or average of all the likely returns of investments comprising a portfolio. So usually this happens from just looking back on all the returns, averaging them out, and then giving you that number. And then you've got standard deviation, which measures the dispersion of a data set relative to its mean. How far out do these different returns go? We'll explain these in more detail in just a second. And then Sharpe ratio is basically like if you had alpha, but instead of using beta to measure the risk, you use standard deviation instead. So let's explain these a little bit more. Mean return is the expected value or mean of all the likely returns of investments comprising a portfolio or of an investment itself. So this is established by simply taking the average of all the historical return data, whether that be by day, by month, or by year, and usually expressing it as an annualized figure, so something that is a yearly number. So even if you're taking the returns for every single day, you're averaging them together, you want to then extrapolate that to a yearly number. Outliers can pretty significantly skew the mean return, especially if your data set is small. So if you have the mean return of, say, a Tesla back in that period where all it did was go up, your mean return looks pretty attractive. But then if you move forward a little bit and you include where it came down, it's going to start skewing more towards the middle, and you'll have a more reasonable representation. So that's again calling back to that law of large numbers. If I look at the mean return of the S&P 500 over year to date, well, it's down. And then you think, well, the average return of the S&P is down. Why would I want that? That you back out further and further and further, and the mean return is both more representative and more attractive. So we kind of use it as a point to reference. So if we have sort of what has it done on average on a year-to-year basis, we can use that as our point of reference for sort of what all of these other statistics will mean. So I'll explain how it's more useful once we get to standard deviation. That'll clear it up a bit. So it's the expected average return based on historical data, and it's not a guarantee of future returns, but it is the basis upon which we're measuring standard deviation, which is the dispersion of a data set relative to its mean. So that basically means if we have an average value in the middle, how far does all of the data that we use to calculate that middle, how far does that stretch out on either side? So this measurement gives us the idea of overall volatility of any given investment, and returns can fall within or outside of that standard range. So I think this graphic kind of explains it the best. So let's say our mean return is in the middle here. You could say it's 5 or 10% or whatever you want. You're going to have different layers of standard deviation. So you'll have 1 standard deviation, 2 standard deviations, and 3 standard deviations, which is basically just a common measurement for all of the data that's within our set that we're measuring. So if we have, say, a 5% average return and a 5% standard deviation, here would be maybe 10% return, and here would be 0% return. So we kind of create this band around the average return. If we have a 5% return, it could go, if 1 standard deviation tells us that we can go up by 5% from there and down from 5% from there, on average, 68% of the time, our returns will be somewhere between 10 and 0. So it really just is saying, based on the historical average, where do we expect the returns to lie on some percentage likelihood basis? So 1 standard deviation is each side of this added together. So that's 68%. Then you can add these and it gets closer to 80 or something like that. And then the more standard deviations you go out, the more wide the band is. It could be plus 50 or negative 100. But then it's more likely that any year is going to fit within that band. Yeah. So if I just like put all of my data in here, you could say at one point it went up by 20, at one point it went down by 30, many times it went up by 5 or 6, and all of that's included in here. This is just going to show like there weren't so many bits of that data over here, there weren't so many over here, but the most common returns year over year existed in this period. Right. Yeah, exactly. So it's like that amount of the data was within here, so you can reasonably expect that most of the time you're going to land there on average. And then again, the numbers for the returns, they get more accurate the more time you have. Yeah, so it kind of gives you an idea of, oh, if this is done 7%, but the standard deviation is 20, I'm like, that could go up and down by a lot. And maybe I want something tighter than that. So it really just kind of is like, how much is this really going to be flying up and down as I'm invested?
The real value is, whatever, if you see a fund that's done really well and you want to own that fund, this will help you understand what they're doing and why they did so well. You don't want to just buy something that's up and then find out the standard deviation is radically high. Or the beta is high or low. This lets you have X-ray eyes and go, okay, I understand everything about this. Or you can look at the mean return, and if, let's say, T. Rowe Price CapEx has done better than the S&P long-term, well, why is that? And you can see it's done better, but then it hasn't gone up as much and gone down as much, and you can get more information. We just want you to be able to select a fund or an ETF that you understand everything about it, the goods and the bads, and they are only good or bad based on the data in comparison to an index.
Exactly. So,
Yeah.
Oh.
The price, is it breakout of the price? They go beyond this,
yeah, so that's what will be included in the further standard deviations. So this is going to be the most common area of return. And then, so it's basically like 68% of the returns lie in here, and then a smaller percentage lie over here. So those outliers will be further and further down this. So if you have some ridiculous breakout, that's going to be over here in that 0.1%. So it will be in the data, but because it skews towards the average, it won't have as much of an impact overall.
Stocks can be, because if you have a stock and it sells for $100 a share, that's what it sells for, or whatever. But if you have a fund, two S&P 500 funds, one could have a share price of $100, the other one could have $5 share price, but more shares. So they're very confusing to try to figure out the price per share. It's just the dollar value relative to one person has smaller shares, smaller dollar, more shares, and vice versa. Or it's like a dividend or a split, right? It's sold for 100, and now you got 2 at 50. There's no change in value unless people get excited or worse.
Yeah, exactly. Yeah. Yes.
It seems like, you can tell the standard deviation by looking at the graph. Is it going way up and way down?
Right.
Right?
Yeah, that's a very intuitive way to kind of, figure like how volatile is this?
Do a number.
Right, exactly.
Much.
Yeah, exactly. So more volatile investments have a higher standard deviation and more stable ones have a lower one, obviously. So if you look at something like a treasury bill, it's not going to have a lot of standard deviation because it doesn't have a 20% return and then a negative 50% return very often. They might have some outlier events where you have stronger up and down swings, but on the overall average, it's a really tight amount of return for the most part. So we can use a target standard deviation to keep our portfolio in line with our risk tolerance if we want to. So if you say you like 8% standard deviation, if that feels pretty comfortable to you, that on a year-to-year basis you go up 8 or down 8 from your average, then you can create a portfolio that's like that. Spoiler alert, that's kind of what a balanced portfolio is for the most part. So you can really just use that to kind of gauge where you want to be. And if you say you plug in your portfolio to a Morningstar, or I run it in Y charts or something like that, we can get what that standard deviation is, and you can think, how have I felt the last while? 12% is a little high for me. That's been feeling a little risky. Then you can tone it down and bring it closer to a level that you think is more accurate. So just a nice full screen version of that so you can really kind of get the idea. But next, we'll talk about Sharpe ratio. So Sharpe ratio is, like I said, it's basically like alpha, where you have an excess amount of return for the given level of risk. But the difference here is instead of using beta to tell us what our risk is, we're using standard deviation. So it's not relative to anything. Sharpe ratio is not saying you're having better returns compared to that thing over there. It's just simply saying, based on the previous time frame and your standard deviation, do we have more outliers to the upside? So if historically a fund has way more outperformance to the upside, its Sharpe ratio should be pretty high. Now I'll say for most normal investments, broad-based, just kind of doing their thing, you're not going to see high Sharpe ratios. High Sharpe ratios are going to be things like above 1 or a 2 or a 3 would be ridiculous. You're not going to see those numbers in most of the things that we talk about. But you also have to remember that the time frame is going to really skew that. So if you've got a 1 year where the standard deviation is pretty low because it's had similar returns through the whole year and those returns are up, the Sharpe ratio is going to look really good. But if it's way more up and down over 3 years or 5 years or 10 years, that's going to start to stabilize a bit. So it basically divides the portfolio's excess return, which is the return above the mean, by a measure of its volatility to assess risk-adjusted performance. And this is basically what that looks like. You just have the return of your portfolio minus the risk-free rate. So remember, that's the actual return that you're getting, which is more than you could get by just chucking it in a T-bill. And then you divide that by the standard deviation of those excess returns. So pretty much just looking at, after taking on that risk, how much extra return are we getting for being there? And so after that, now we basically covered a lot of the main things. There's a couple extra things that we want to discuss. So there are a couple things that are related to bonds. Two will be average effective maturity and average effective duration. If you remember, the maturity of a bond is pretty much how long does this bond last? How long am I lending them this money for? If I've got a 10-year bond, I will hand the person $1,000 and we'll say in 10 years, over the 10 years, you'll be paying me interest so that I get compensated for it. Then at the end of that 10 years, you give me my $1,000 back. So the average effective maturity of a fund is basically looking at all of the different maturities within that portfolio and creating an average number from that. Considering all things like if you've got prepayments or the ability to call a bond away and basically end the contract early, it's putting that in all into account. So saying, okay, effectively, what's the average maturity here if we're also considering all the extra stuff that could shorten the period of time in some sort of way. Average effective duration is similar. So it takes that average effective maturity as well as the amount of interest that's being earned on all of those bonds, puts those together, and the way I kind of like to think about it is you'll have maturity and then you'll have your duration. Your duration is always going to be a little bit lower because the interest is going to basically shorten that time frame for how long it takes for you to get paid back. So if I say, for example, I want to give you $100 and in a year you're going to give me my $100 back. Well, for every time that you pay me interest, even if we say it's $1, like 1% interest, let's say you pay me 1% every month. Let's just use a ridiculous example. So in the first month, you give me that dollar. Now I'm a little bit closer to being paid back for the $100 I gave you. So that's actually slowly shortening the duration of how long it takes for me to get compensated compared to how long the loan actually lasts. So if we get somewhere and it's like, you're towards the end of it and go, I've basically been paid back if you consider how long it's going to take for my principal to come back. So that coupon or interest rate or yield is going to bring down the maturity to the number that's called duration. And what duration practically is going to end up meaning is interest rate sensitivity. The longer a fund's duration, the more sensitive the portfolio is to shifts in interest rates. So if you've got, say, really long maturities and a really low interest rate, your duration stays really high, which means that as interest rates change, your bond's going to move up and down a lot. But if you've got a little bit shorter of a bond and the interest rate is really high, so it pays a lot of interest to you, a lot of yield, that duration is not going to be as high because the interest rate is compensating you for the period of time, and it's not going to be as sensitive to interest rate changes. So that's why you'll see something like maybe T-bills and high yields. While the high yields have lower credit ratings, there's a higher chance that they may not pay on that loan. When interest rates change, the T-bills will actually be slightly more volatile because they don't pay as much interest in comparison. So if you have a 1-year high yield bond and a 1-year treasury bond, the treasury bond is probably going to pay less because the credit rating is higher. So that means that if the interest rates change, you go, oh, now I need to pay, say interest rates go up, I'm not willing to pay as much for an existing bond because if I pay the same amount of money, I'm going to get the same interest as before the change, versus with something like a high yield bond, because relatively that change is less, it's not going to impact the share price very much. It's very confusing, but basically just understand that when you see duration in regards to a bond fund, it means how much is the value of my fund going to change when interest rates change. So if my duration is 1 and interest rates go up by 1%, it's likely that your bond fund will decrease by 1% to compensate and make the values equivalent.
On that, because I'm still, I'll study and try to figure it out, but we've changed, because all the other things you did, like mean return, standard deviation, alpha, beta, and R squared, those all have to do with the stock market, right?
Well, they just have to do with returns in general. So they do have to do with bonds, because bonds will still fluctuate in value. So it just has to do with investments that change in value, and that's it. So it's everything. These are just more specific. Right, exactly. Yeah. So the other thing that we talk about when we talk about bond funds is credit rating. Now, we actually got a bit of a handout for that one from the SEC. They teach you a little bit about how credit ratings work. So if you're interested in that, you can give a read to that. But credit ratings are an independent assessment of a company's or government entity's creditworthiness with respect to a particular debt or financial obligation. Basically, is this company likely to pay me back on this bond, or is this government likely to pay me back on this bond? So you've got a whole bunch of different credit ratings. Remember, we talked about S&P and Moody's, then you've also got Fitch. So they each have different ways that they represent those credit ratings, but they're pretty similar. So everything that is above this red line, that's going to be what's called investment grade. So for the most part, we consider that to be good enough for your average investor. It's not a huge amount of risk. Those are probably going to pay back their loans on a reliable basis. And then everything below this is called junk bonds. Or if you want to be a little nicer, you call them high yield. And that's how you're a little bit gentler in your description. But they are called junk bonds. So these will have to pay higher interest rates to compensate for the fact that it's less likely they'll pay back the debt in the first place. You kind of think about it as like, if you have like a 400 or 500 credit score, you're going to be down here in this high yield area. But if you've got a 700 or 800 credit score, you're going to be way up there. And the credit card companies might charge you less interest. Your car loan's going to be less interest. Your mortgage is going to be cheaper. But if you don't show a reliability to pay back debts, they have to basically shorten your duration risk. That's why they increase the interest rate, is because they need less of a chance for you to get to a certain period in the loan, not pay it back, and now they lose their compensation. So there's kind of a relationship there if you think about it. So like those mortgage companies, loan companies, they want to shorten their duration risk if your creditworthiness is not very high.
And the chart there, that's why you might pay a higher amount for a managed fund, right? If you go from junk down, it might be a good idea to have a PIMCO or somebody that's really good, because there's no bond market like the stock market. You have to know your credit sources and all the people, so you need some hands-on eyes. So if you're going to take risk of junk bonds or high yield bond, you could get an index, but it's a good idea to have a really good bond manager who has a lot of information.
Yeah. So one thing that's interesting in this, oh, yes. That's just how they decide to do it.
So what's the
Right. Yep. It's just exactly the same as what's next to it. They just simply decide to represent it in a different way. Yeah. So something that's interesting on this handout is just what a credit rating is not. So a credit rating does not reflect other types of risk, such as market or liquidity risk. So if the bond market just flies up and down, like not related to the credit rating, that's going to be a different type of risk that the credit rating can't tell you. Or if interest rates change, that duration risk. Credit rating is not really going to change that for you. Sure, the lower credit ratings pay higher interest, so that sort of compensates for the duration risk, but interest rates can change by a lot. I mean, remember, and it wasn't that long ago that they did. they went flying upwards. And if you were in long-term bond funds or a target date fund, that thing crashed by like 35%. It was crazy. So, nor does a credit rating consider the price at which an investor purchased a security or the price which the security may be sold. So it's just basically saying all the other risks are not represented by credit rating risk. But there's some cool information in here. And back in 2008, one of the interesting things in regards to credit ratings was, if you remember, I don't know if anybody's watched the movie The Big Short. It's one of my favorite movies ever. It's so great. I love it. It's like, it's just enough of like fun Hollywoodness and action while still being kind of accurate. So I really like that. But basically they were talking about when there were these synthetic products that were bundling tons of really bad mortgages together, low credit rating mortgages, they would bundle them up in this synthetic product, bring that to a rating agency, and then because the ratings agency just wants to get their fees that they charge for giving a rating, they would just give it an A rating, even if it should have really been a single B or a double C or even a D. So they were taking and fraudulently rating products way higher so they would seem like lower risk, and then they would be able to sell these to retirement funds, pension plans, and all other types of investors that expect a higher quality product and a lower risk. So that was a really interesting thing in 2008.
A question about these different ratings, my guess is, if you're a bond buyer, maybe look at the difference between these agencies on how they evaluate stuff and just use only Moody's, only S&P, or only Fitch. Once you find out if you're going to be a bond buyer, which one you trust the most. But,
Which of those, or did all three of them, were?
I know S&P and Moody's were both contributors to that because they were competing basically.
Right.
So like if somebody went to Moody's and they didn't get the rating they wanted, they would just walk on down to S&P and go, "Can you give us the AA?"
And they generalize things, because right now you would say the safest bonds to buy would be treasury bonds. But what if the government had shut down, they didn't pay the interest, or whatever happened? Corporate bonds, in 2008, corporate bonds and things held pretty good too. But if we all of a sudden feared the US government's not gonna pay,
Right.
we guaranteed everything on that, and all of a sudden that falls apart. So that's what they did, is generalize and came up with good excuses to get high rate.
So do we have ratings for government bonds?
Yeah, they're always AAA every time.
Yeah, but.
Yep.
For Taco, AAA.
I'm not sure actually.
Yes,
I
they
don't know.
have. In the 90s, they actually dropped a bit, and that was a big scare of corporate bonds. That's what you
Yeah.
don't want there.
Yeah, so agency bonds can be a little bit different, but if we're talking about treasury bonds, it's crazy that I can, but I can basically say that, like, I can give advice on treasury bonds without a license because they're considered guaranteed. Yeah, that's like the only investment that's considered
If we
guaranteed.
keep going into debt, like wherever you want, but if we keep going to debt and we have like Italy and these other countries, their ratings went down on their government bonds. Our corporate bond, government bonds could drop. They have in the 90s, we dropped and then we got back, but if they kept dropping, then you've got the value is lost, but you have to pay a higher interest to get people interested, and then you're in trouble.
Yeah.
So bonds aren't the same place that I do.
If you buy it, wait for it to mature, and it's issued by the treasury, you're going to get that. The inflation might cause it to go down in value. There is no guaranteed investment out there.
Yeah.
Absolutely.
China and Japan, they're all getting rid of their US bonds and getting rid of the cash in.
Right.
Is that gonna affect the rate?
I don't know that it was
So-
short term, but if they sold, the prices could come down if it hasn't matured, but I haven't heard that.
Yeah, I don't think that would have that much effect on the actual rating because, I mean, there might be some like sort of down the line effects if now suddenly the economics, because obviously the government just keeps selling the bonds and that's how they get a lot of capital. So that could be a downstream effect, but it's not going to be a direct relationship just like that. That's going to mostly affect the actual share price of the bonds more in the short term.
Trying to move away from the dollar.
Right.
And so they're all selling and shorting their living in bonds. And I guess in the hopes of having BRICS, they're determining the Chinese, I don't know, what's the currency for?
You're on
They want to make that
Right,
the currency of the trade.
right.
I don't understand. A lot of that stuff, the best thing we can do is reduce our debt and improve our production of the dollar and the US economy. So,
Yeah. Yeah.
so
So the last couple things that we want to consider, there's a couple more things here, and then after we're done, I'll show you what all of this actually looks like on Morningstar with a couple examples. But two more considerations that we want to think about. One is our 12-month yield. So this is basically a trailing measurement of how much income has been distributed from a fund in the last year. So it's the sum of all income distributions from the previous 12 months divided by the last month's ending net asset value. So basically saying relative to what's in the fund, what percentage of those assets have been paid out. So income refers to interest payments on debt and dividend payments from equities. Potential capital gains exposure estimates the percent of a fund's assets that have unrealized gains. So if we're looking at, say, a mutual fund and they do stocks, they buy and sell stocks, you might have a quarter of the positions at really high capital gains. So it would have a potential capital gains exposure of 25%, saying that, okay, there are some securities in here that if the fund manager sells them and then passes those capital gains out, that's going to hit your account and you might have a tax bill. As we talked about before, ETFs don't really do that so much, almost never, but mutual funds absolutely do because they're treated more like a pass-through investment. So a negative percent indicates capital losses, which could be used to offset capital gains in future years. This is something a fund manager will do all the time, especially if they go to do a rebalance or they're changing their strategy. We go, I got losses here and I got gains here. Let's net those and have a zero impact, and then you're able to move on to the next thing that they want to do. So this is really only a concern for non-qualified retirement accounts, because just like a dividend, if you've got it in an IRA and it gets paid out and hits your IRA, you don't have any tax bill that year. The only tax bill you have is when you take the money out. So one other thing in regards to yield, which is something that I use more frequently because I find that they don't show 12-month yield as much, especially on portfolios, but it's called SEC yield. And basically it looks at a shorter period of time. It might look at the last 30 days or something like that. And then it'll have a more recent calculation of the dividend yield. So you might have an SEC yield slightly higher because they just bought stocks that pay more dividends, or the share prices came down, versus the 12-month year is going to be more of an average